Good evening and welcome to Boston University's Real Estate Club Guest Speaker Series, for conversations about real estate leadership management and people who have achieved something in our society. Today, we are honored to have Gary Whitelaw, the Senior Advisor, Investment Committee member, and recently retired CEO of BentallGreenOak with us. Today, BentallGreenOak, or also referred to as BGO, is a leading global real estate investment management firm with more than 55 billion in assets under management. I'm pleased to welcome to this virtual room, Gary Whitelaw. Good to have you here, Gary.
Thank you, Michael, and good evening, everyone. It's actually truly a pleasure to be with you. My wife is a graduate of Boston University. She did her master's in communications at the same time that I was doing business school just down the way in Cambridge. And our daughter, Kate, was actually born at Brigham and Women's, just down the way, just probably, a mile and a half, I guess, from BU. And so she has dual citizenship, and we go back to Boston a lot. We love the Cape, the North Shore, the Berkshires. It's just such a wonderful place. And actually, one of my very first jobs was working for an architect. My first career before business school was engineering and architecture, and I worked for a firm called Moore and Amara that were based in Waltham. And they did pretty much all of Hewlett Packard's architectural work. And so that was really fun, actually. That was back in the 70s, I'm ashamed to say. Well, the only thing I would add to my comments already about Boston was I had the dubious pleasure of running the Boston Marathon in my second year at business school. Back in the good old days when you actually didn't have to qualify, they let all the serious runners go first, and then they let us go. And of course, I didn't overtake any of them, but it was a great experience. And my wife talked me into going out for dinner in Cambridge that night. We didn't have a car, so we had to walk. But when I got up from dinner, I was completely seized up and had to try and find a taxi and get home. So that's my other memory of Boston back in the good old days.
That's very impressive. I didn't know you're such a runner, Gary. If I was involved in the Boston Marathon, I'd probably be the water boy handing you the cup.
Well, my time didn't set any records, but it was fun.
So let's talk a little bit about Bentall now. You joined the firm as a CEO when it was a subsidiary of BentallGreenOak back in April of 1998, which ironically, that is pretty much almost exactly 23 years ago till today. At that time, Bentall was a public company operating in Canada and down the United States West Coast with approximately 2 billion in assets under management. Then flash forward to today, on June 30th of 2020, when you handed over the reins as to CEO to Sonny Kelsey. BentallGreenOak had offices in 24 cities in 12 countries across North America, Europe, and Asia, with 51 billion in assets under management. Quite an amazing accomplishment. Can you tell us a little bit about the role that BGO plays within the spectrum of global real estate entities? And also, please tack in at the end, if you can, a little bit about the trends and forces in the industry that you're able to harness and create such a tremendous growth over these 2 decades of leadership.
Yeah, happy to. And I'll try to keep the answers short so we leave lots of time for questions. In the spectrum of real estate developers, public or private, but let's say, focused niche players in a region or an asset class, all the way to public real estate companies. And I know Sam Zell has been here to speak with you, and OT, Owen Thomas, and others. We occupy a different niche as an advisor, manager, investment manager in real estate. And it's really in 3 of the 4 quadrants: public, private, equity, and debt. We don't really do much public debt, but we do some public real estate investment. We do an awful lot of real estate equity investment, and we're also quite a big mortgage lender around the globe, Europe, UK, Canada, US. We have about 550 capital partners investors, not in our business per se, but in portfolios and in some large single assets on whose behalf we invest. We develop from scratch. We develop probably 2 billion a year. When conditions are ripe, we'll be doing 3, 4, 5 billion a year. And some of those are long-term holds, and some of them are more tactical momentum plays. We acquire 10 billion a year, something like that. The average hold period, will depend on the vehicle. Our funds or our separate accounts run the spectrum from real core, the large gateway markets, top quality, diversified properties like high-rise office. Not a ton of retail, which these days is a good thing. Most of our retail is grocery anchored by design, and that's held up very well, and we're happy with that. We do an awful lot of logistics and industrial. We have a $2.5 billion separate account with CalPERS for that. We've got several global funds in Europe and North America that focus on logistics, and that, of course, has done very, very well over the last while. But our role is to be the fiduciary, to be the advisor on behalf of typically pension funds, sovereign wealth funds, some of the big sovereign wealth funds in the world, trusts and endowments, university endowments and public and private trusts, and insurance companies. And within that spectrum of clients, they have very different objectives for real estate. Maybe we'll talk a little bit more about that in a minute, but in some cases, their focus is to essentially be a fixed income substitute. Back in the day when fixed income generated 6, 7, 8%, a lot of these portfolios had very big fixed income investments. But as interest rates have declined, and that's really one of the major trends, they're not able to get the return they need to pay their pension obligations, feed the endowment, or match a liability if they're an insurance company with as much fixed income as they used to have. So really the big change has been real assets, real estate and infrastructure principally, assuming a role of generating strong, predictable, reliable income with a 200, 300, 400 basis point spread over fixed income returns for corresponding duration. There are some clients that have already established those core portfolios in various ways with us or with others, and then they look at real estate as a form of private equity. So they would go into value add funds or opportunity funds. Blackstone is fantastic at that, as is Brookfield and a number of others, but more at that higher risk, higher return end of the spectrum. We've got a variety of vehicles, funds, or dedicated accounts or clubs that invest across that whole spectrum in North America, in Europe, in Asia.
Great. Thank you for that, Gary. I think a little bit more, let's move on a little bit to, I think a good talking point would be about some of the biggest challenges you faced throughout your career. And when you came across those challenges, how were you able to overcome some of those?
I think I'm certain you've heard this. It's certainly not my phrase, but the Chinese character for crisis is also opportunity, right? And so I think many of the greatest challenges have presented the greatest opportunity. One of the greatest challenges is attracting, retaining, nurturing, working with great people. Great people have lots of choices. Great people are ambitious and want to feel like they have control over their destiny, and they want to be able to act and be treated like an owner of things. And one of the things that I've really noticed is that people that have choices generally will not stay with an organization for a long period of time if the corporate values and the purpose of the organization do not reflect their own. And we'll come back, I think, Michael, to ESG and other things.
Yeah.
But I find ESG is a wonderful example of that these days. If you've got, and it's particularly true with your generation, that if you're in it for only the money and people don't feel like they're contributing to their community, to the doing the right thing for the planet more broadly, if they're not able to be inclusive, it's very hard to keep those people. And so one of the things we've tried to do is articulate what our corporate values are, and then that becomes, frankly, a filter and a bit of a self-selection process. So I would say that's a forever challenge. I think it's like a family. You never put your feet up and say, my work is done. Attracting, growing, understanding, learning from really talented people is a huge challenge, and it's an enormous opportunity.
But what about some enablers as well? I think that would be kind of interesting. Like when maybe some people weren't able to achieve much growth, or there were some difficult circumstances, how were you guys able to go about that?
I still remember, we all have these moments in our careers that we remember years later. When I took the job in '98, what the fellow that hired me carefully concealed was that 50% of our capital came from one client, and we were in the penalty box with that one client. And they hadn't given formal notice, but it was getting there. And so building a relationship, rebuilding a relationship with that client was job one. And it's one of the very, very big public pension funds that ultimately went from 400 million when I joined to 14 billion. So, became a very, very big client. And we did really well with them. We gave them, over that 25-year period, we gave them a 13% net return compounded annually. But the company had made some big mistakes, and I was called in to atone for that. And because I didn't have history, I just said, yeah, we screwed up. Like we've got to fix this, and this is what I think we can do. But let's communicate and let's solve this together. But yeah, we've got to fix it, and we did. And he said to me 6 months or a year later, there aren't enough hours in the day for me to police people that are supposed to be my trusted advisors. If they make a mistake, I understand that they're human. If they don't admit to the mistake, if they try to solve it and cover it up, if they come to me only when they've either solved it or been unable to solve it, I will never trust them again. So I think one of the big lessons for me early on, and what's been an enabler, is you're going to make mistakes, but you have to build trust. And I think that goes to your clients, clearly. It goes to your investors. If you're a public company, it's to be CEO of a public company is a position of trust. It really, really matters to your employees. Do they trust you to look after them and to do the right thing? And your partners, in the industry. I mean, more and more and more people are joint venturing, right? And you might be the smartest guy in the room, but your reputation precedes you. And if you try to get the last nickel at your partner's expense, that catches up to you. So I'm not saying that's me. That is the ethic that I stepped into because the Bentall family lived their lives and built their company that way. It is today 120 years old. there are not a lot of companies that are 120 years old, and I think they built the right foundation of trust, and I think that goes a long way in achieving a lot of other things that you need to put in place in order to be successful.
Well said. And I think a good question to throw in, running off that prior one on why you were able to achieve growth when others couldn't, or challenges were, or circumstances were pretty challenging. How much of your guys' growth was organic versus maybe through merger and acquisitions? And why the mix? Was one a more successful strategy than the other?
Well, and let me just finish that last point. What I didn't say and should have is that the growth with that client fueled growth with 25 other clients, because he was a very hard critic, very well respected. And if we could do well for him, we could do well for others. And he enabled us to develop a track record in different areas that we could then use to grow the business. So, I think that relationship was pivotal in that. But to the point about track record, one of the big forces that has led to our growth, or created an imperative that led to the growth, is the globalization of capital. People now are investing around the world, and sounds very obvious when you say that today, but 10 years ago it wasn't that obvious. In real estate, they were investing in equities and fixed income around the world, but real estate was thought of as a very local business. In the US in particular, there are a whole bunch of very powerful consultants, the Townsends of the world, or Mercer or Aon, who are gatekeepers for capital. Understandably, they don't want to take a gamble on somebody who has a bright idea but relatively little experience in that area. So one of the impediments to growth is that even if you've really done your homework and you've got an excellent idea, attracting capital to something where you haven't proven yourself is very difficult. So for that reason, we decided early on what we needed to do, both by product type and by geography, was to find like-minded organizations with whom we could merge. And in many cases, that took the form of an acquisition. If the founder or founders were of an age where they were ready to kind of cash in some chips and stay involved, but begin to edge out a little bit. So we did about 7 acquisitions over the years, including Kennedy, which was a large Seattle-based US advisor that at the time managed a fund that was about $4 billion in assets. Today is about 11. So we acquired initially 1/3 with an option to go to 2/3, and then full ownership of Kennedy, and merged it together and became Bentall Kennedy. We acquired a number of other entities along the way, and our up until the last 2 transactions, the sale to Sun Life and the merger with GreenOak, our growth was about 50% organic and about 50% through these acquisitions in complementary regions or in complementary product types, where we could then pull the team together and have a track record that consultants would buy. Now, it was critical that you kept the people around, because if you just had the track record, not the people, people didn't give you much credit for that. And that's where creating a culture where people would want to stay around meant so much. We did get to a point around 2013, 2014, where this globalization trend was so powerful. And you were beginning to see, coming out of the financial crisis, the really big pools of capital wanting to consolidate managers. And over 50% of the total capital raised in 2013, 14, 15 went to the top 10 of 200 managers. So we realized that we needed to achieve some scale, but we needed to have a sponsor that could help us grow. And that's where we began to look for a strategic sponsor, because we had been 1/3 owned by management, which was wonderful. And then 1/3 owned by one of the top Canadian pension funds, and CalPERS, one of the top US pension funds. And we had separate accounts with those clients. And frankly, that was most of their interest, more our growth and performance in the separate account than it was the business itself. And so we needed someone that could bring a balance sheet to bear and was really interested in the growth of the business. And we went through a strategic process with investment bankers. We narrowed it down to 3, and then Sun Life, who are today just under $1 trillion in assets under management. They own MFS, who Boston-based as well, who you folks probably know quite well, and have owned MFS since the 90s. They own about 90%, and management owns about 10. So we went through a process, and they emerged as our clear first choice, and thankfully they liked us. And out of that was a plan to grow globally. And we went out again with investment bankers and looked for a really good fit. And that's where Sonny and John Carfield and the team at GreenOak kind of emerged as such a logical combination with us. And I'll finish quickly here by saying that, again, back to people, Amy Price, who is today president, she really stepped up as global president as I handed the reins to Sonny. He became CEO, she became president, was our head of the US business, and had worked for 15 years with the team that became GreenOak at Morgan Stanley. So she and Sonny and John and Chris Niehaus and many others went back 15, 20 years and knew each other well. And that's what gave us confidence that while we were in different businesses, we thought similarly, we had the same values, and we could come together as a firm, challenging as that always is. And it has worked out very well.
Well said. And guys, that is really honestly golden information you're sharing with everybody. It's firsthand on how you really could scale a company. I think one of my personal beliefs is mergers and acquisitions is a great way to do it if you know how to do it properly. So that's really exciting to listen to and learn from. But let's,
as the other old saying goes, start with the culture and the people, because Peter Drucker, culture eats strategy for breakfast.
Cole, are you a Peter Drucker guy?
I mean, I read a few of his works, but just a few pieces.
I knew it.
But I definitely agree with that strategy.
Everything.
He's pretty awesome, Cole. He's the real thing.
Yeah, definitely.
So let's talk a little bit about ESG as well. I know that's a huge topic for discussion. It's becoming more and more important in the industry. So Bentall and you personally were early advocates of ESG and sustainable investing, and have been a global leader in the space for over a decade. Why did you and the firm become so passionate about ESG?
I think like so many things, it sneaks up on you a little bit, and as you keep your eyes open, you realize, gee, there's something to this. I mean, climate change, we signed the UNPRI, I think in 2004, very early. It was driven by an awareness that climate change was really starting to impact a lot of things and was going to get worse, and that real estate plays a very, very big role in carbon production and can be a big part of the solution. Interestingly, we saw more and more of the really big clients, CalPERS, PGGM in the Netherlands. They invested $300 million in our US fund, almost exclusively because it was the top rated North American fund for ESG. And then a lot of other people have followed their lead. So, I think it was a couple of converging thoughts. One was this climate change thing is serious, and we got to take it and pay attention to it. We were hearing more and more and more from our clients that ESG really mattered to them, that they had objectives to achieve in each of the asset classes, and real estate was no exception. But then the thing that really snuck up on us was, I touched on it a few minutes ago, was so many of our employees really, really cared passionately about it. You know, and I don't mean just a young, recently minted MBA. The 55-year-old building operator with his name over his pocket really cares, you know, and if he can help you figure out how to reduce the cooling load or how to recycle rainwater, he or she are all over that. And it was a wonderful way to kickstart innovation. You know, if you sit down with folks and say, there's got to be a better, more efficient way to get through our annual budgeting, everybody kind of rolls their eyes and says, God, wake me when this is over. Yes, we probably should be more innovative and efficient in this area, but it's pretty dry. But if you take a team together and you say, we have this high-rise downtown Boston, how do we cut the stuff that goes to landfill in half? What can we do? You know, and it was just amazing because all these ideas would bubble up, and it wasn't like leadership saying this is what we have to do. It was everybody across the whole company saying this is what we can do, this is what we should do, and the people that were kind of stuck in the mud and didn't really want to change the way they'd always done it became the outliers, and the people that were keen on innovating became the driving force. And so, you know, we did that. We cut waste to landfill by 80% across the entire office portfolio. And the other thing that's really interesting is you can't do it just as the landlord. Your tenants are the ones that actually occupy the space, you know. So what it meant was, beyond keeping the building clean and collecting the rent, there was a role for us as a facilitator, as the landlord, to bring the tenants together to say, folks, we'd all like to do better. We'd all like to cut emissions or whatever. How do we do this together? Because if 2 of us are doing it and the other 8 aren't, we're not going to really move the needle. But if we do it together, and so all of a sudden you've got representatives from the different tenants who get to know the landlord, and you have these meetings at lunch hour, and a different kind of relationship emerges where you're facilitating something, not enforcing something. And it's been wonderful. It's been such a virtuous circle in my mind. And I think it's gone from being something that we felt we should do to something which is a real competitive advantage. And, you know, we've had a saying for a while now, invest solidly and invest sustainably. And the sustainably is meant to be a bit of a play on words, where it's not only sustainable from an environmental standpoint, but it's durable, it's long lasting. And I think the real business point here goes to obsolescence. That if you have a building that is 20% less efficient in energy use or operating cost, that is money that does not go to the bottom line. That means that your building down the road will trade for less than a building which is more efficient. And in a gross rent market like San Francisco, you know, we bought a building on Sansom Street, just by the Transamerica Pyramid, that was pretty good, but we were able to cut about $4 a square foot in operating cost out of that building by making it more energy efficient and water efficient and other things. That's a gross rent market. The tenants pay you $60. So if you can save $4 in operating costs, that's $4 that goes right to NOI, you know, and that isn't always quite as direct, but in multi-res, it's exactly like that everywhere. And in more and more markets, they're sort of quasi-gross. So it's also better business. And I think it's now understood as such.
Thank you. And let's talk a little bit about, let's shift focus just towards the people at an organization. On a scale, I'd say 1 out of 10, how important do you see the role of talent selection and leadership development in building a successful real estate firm? Also, viewed from a young employee's perspective, how do you feel we should be evaluating a firm's ability to teach us to be strong professionals and strong leaders?
I think for me, it's sort of as simple as if you don't get the people right, it's only a matter of time until everything else starts to maybe not crumble, but starts to deteriorate. I think there's kind of a virtuous circle or a vicious circle. Depends whether you're going clockwise or counterclockwise. To me, in the top left corner is people, talent, culture. That is the input which you can control. Not perfectly, but you can select the people, you can really spend time with them, you can be respectful and invest in their careers and become maybe not the employer, but an employer of choice. And if you attract and retain those people, they will drive investment performance. And with, because 2 or 3 people at the top can't, not if you're scaling the business. We lost the ability to do that at 1 or 2 billion. You get to 50 and there's no way in the world that a handful of people can make all the necessary decisions and then execute well on them. It's your team. If you've got really strong people, that drives investment performance, that attracts capital. Whether you're a public company or a private investment firm, capital wants to go to the strong performance, and that performance drives, and that capital drives growth and new opportunities, both for the firm and career opportunities, which attracts more people. It's a flywheel. But you don't just magically start with strong performance or capital. You start with the people. I don't know. Maybe AI is going to change that, but I think it's still going to be the essential ingredient. If you don't have good people or the good people don't stay, it goes the wrong way.
Well said. This will be a fun one because we all know this saying, but from back in the day, I hear it today as well. The famous saying that the 3 most important things in real estate are location, location, and location. As we've learned throughout this pandemic, with people working remotely from locations all around the globe, technology may be rapidly changing this truism, or at least diminishing the primacy of location. Do you think it is still all about location, or are other factors becoming more important?
Zeckendorf, I think, was the man that said location, location, location. It's always been important and will be important. Although I do think that we're learning that you can work from around the globe and make a real contribution. But I think it's a people business. I've made my views clear on that. I think I would have said people is right up there with location from the very beginning. And that's because the other piece of that triangle for me is tenants. We should never forget that they're the ones that pay the rent, that generate the income that the investors want, and ultimately determine the value of your asset. And so I think there's a tendency for us to focus on bright, shiny buildings and the cost of capital and forget about the people that populate those buildings, whether they're office tenants or residential tenants or in a data center or life sciences building or whatever it is, right? So I would say it's always been about knowing your tenants and just servicing the hell out of your tenants, being the landlord they want to stay with. I think by the time a tenant gets to the last couple of years of their lease, they've more or less made up their mind whether they want to stay or go. They may push you very hard, and they generally do, for the right financial deal. They may find themselves expanding and unable to be accommodated in your building or going the other way, contracting. But all things being equal, you want to be the person with whom they want to renew. Then you're going to get them on better financial terms. And that goes back to, the ESG example where you're developing a relationship with them that goes beyond it. So I've always been terrified of commodity buildings, power centers, where I think that the tenant has way more power than the landlord. I've always liked real estate where the landlord can make a difference to the tenant, can create a switching cost, so the tenant is disinclined to play you against the next guy. They may negotiate hard, but at the end of the day, you're kind of confident that they'd like to stay with you. So I don't think technology really changes that. It changes the way you interact with the tenant. You better have prop tech and good apps and the ability to provide them with really strong connectivity and all those things. That all combines into the tenant relationship. But to me, I would put tenants, location, and people as the essential ingredients in successful real estate investment.
Cole, you have a question?
Yeah, I was interested in your statement on switching costs. What are some examples of ways that properties can introduce switching costs?
That's a great question, Cole, and it's evolved over the years. Used to be when you had a bank that spent the money to put a vault in their branch, you knew that they were there for life. Today that doesn't matter much. It used to be when you had a law firm that spent a fortune on millwork, then that was a big switching cost. They didn't want to leave that. I think one of them is, are you in that top tier of ESG buildings? That's a switching cost because it's hard to replicate overnight. Do you have, and I truly believe this is going to become important again, but 24 months ago it was incredibly important. Do you have a walkable location? Do you have amenities nearby? And the facilities that people can enjoy at lunch hour, whether it's gyms or shopping or whatever, and can they get there by transit? That's going to come back. People may shop online more, but they're still going to enjoy going out for a walk at lunch hour and browsing or something like that. I think another one is connectivity. Do you have superior fiber? Do you have other forms of technology that they need to be competitive? And that's becoming more and more and more important.
Feel free, guys. Raise your virtual hand if you have a question, and we'll call in the order of whoever. So yeah, Lucas, go ahead.
Hey Gary, thanks so much for being here. We really appreciate it. I wanted to ask a little bit about kind of how real estate is transitioning in a digital sense. Obviously, like sectors like office and retail have been a little bit disrupted, and we see like cell towers and things like data warehouses are kind of rising in prominence. How do you think that real estate will continue to trend digitally, and is that a strategy that Bentall is keen on pursuing?
Yeah, good thoughts there, Lucas. I mean, it's an unstoppable trend. There's no question. I think everybody realized a decade ago this was the next big thing, but in so many ways, COVID has been an accelerant, and that's a primary example. I think it's interesting. You look at the spectrum of public real estate companies, and it's very broad. Goes well beyond the four main food groups: office, industrial, multi-res, and retail. As you've mentioned, there are cell towers. Digital Realty is a monster and a great company. There are seniors housing, nursing home, life sciences, et cetera, self-storage, a whole gamut. So I think you're going to see that trend become more and more established within private real estate as well. I know that pension funds are increasingly looking to those other categories. We identified logistics quite a while ago as an area that we thought would be the beneficiary of e-commerce. And so we've gone long with logistics, and some of it is acquiring existing. Much of it is developing our own, and some of it is a very important part of it is partnering with firms that have either sectoral or regional expertise in logistics. So we JV those, and often we're the majority capital partner, but they're the hands on the ground operating partner. I think there's no turning the tide on those trends, and we will see. We're investing in places like Pittsburgh, where there's a real center of excellence around autonomous driving coming out of Carnegie Mellon University. So I think there are micro markets that are being driven by those trends. Austin is a well understood story now, but there are new Austins emerging all the time. So I think it's the asset class or the product type, but it's also the micro markets that are being very heavily defined by technology. Office buildings, I think what we face now is not business as usual for office. I think it's the equivalent of a very significant recession in terms of the reduction in demand for office. And what's happened in every recession in my career has been a flight to quality. Now, you might define quality a little differently, to the question a minute ago about switching cost from coal. I think it's probably more about connectivity and other things today than it is being at Main and Main. But I do believe that collaboration, creativity, and quite frankly, compromise is driven by in situ being together. I think people instinctively communicate and share ideas much better. And you can do this when you know people well, or you can do it to a degree. But if you've got to really prioritize, as you always do, because money is a scarce resource, it's hard to do it when you're not in the room together. So I don't think it's going to be 5 days a week, 48 weeks of the year, but I think it will be as important as ever that people come together to do the really clever and challenging things.
On that note, are the big institutional investors and pension funds, do they still have an appetite for like you said, those quality office assets? And how have you seen the appetite for other office properties kind of decline?
The public markets have either got it right or overshot. I will say that we all learned a lesson in 2008, 9, 10, where values overcorrected and fell materially. Some of the best office buildings in that period fell 30–40% in value. Now, their tenants were in trouble in many cases, so there was a logic to it. But within a few years came all the way back. And so the people that hung in there and didn't crystallize a loss halfway through did really well. People that doubled down in 2012, for example, did really, really well. I think there's some of that here. I do personally believe that for somebody like Boston Properties, I think the public markets have overshot. They've overcorrected. I do, however, think that private real estate probably hasn't seen some of that adjustment yet, because there's been so few comparables. There have been so few trades of real quality office that it's hard for appraisers to point to the data. So I think, as is so often the case, is somewhere in the middle. But I really do believe that there will be a buying opportunity here for the best quality assets. I know we're not selling our best quality assets. We're selling things that we think are not the right strategic fit, or in some cases, frankly, should be in other people's hands, where we've done what we can do, and there's a local sharpshooter that can take it the next mile, that sort of thing. But I think that the most recent survey that came out, Hodis Weil survey, had a strong majority of funds still allocating capital and still under invested in commercial real estate. But to your earlier question, they're shifting the mix a little, and there's probably more going into data centers and life sciences today. Cold storage is one that we love, and a little less into conventional office, and certainly not that much into shopping malls.
Thank you so much, Gary. That's fantastic.
Pleasure.
Elijah.
Hey, Gary, thanks so much for being here, just offering your insights. We definitely really appreciate it. You mentioned a lot about people and how great people drive returns, which in turn allows you to get more capital and then to have greater returns. So I'm just curious if you could shed some light on, what makes great people? Like, what are the characteristics that make great people, or things that you've noticed? And then maybe you could speak a little bit on how do you retain those great people, beyond just cutting them a fatter paycheck, I guess. I'd love to just hear your thoughts.
Fatter paycheck only keeps them for so long because they know they can get an even fatter paycheck somewhere else. I think there's no one answer. It's a very good question. There's no one answer to what makes a great person. It depends on what particular focus. What makes a fantastic investment person is different than what makes a great leasing person or development person. In some cases, I think within our company, I want some people to perpetually see the glass as half full and come in and chase that rainbow. And then there's others, I want them to think real hard about the downside and not necessarily be a pessimist, but be a paranoid optimist. So it's different depending on where in the industry and where within a firm you want to go. And I think that would take me to self-awareness. I think having a real good sense of what gives you energy, where you think you can make a difference, because I really do believe in Maslow's hierarchy, and once you satisfy those immediate needs, it goes to purpose, and people define purpose very differently. But I think what gives you energy is what you think is really purposeful. I think curiosity is incredibly important. The questions about technology and digital, it's changing every hour of the day. And so I think someone who doesn't think of learning as something you do when you're young and one and done, but it never stops. And I think that's by being curious and asking questions and reading and going to industry events and kind of all those things. And engaging with people that have a very different point of view. Diversity doesn't just mean color or gender. Diversity to me is about those things, but also very much about a different point of view, a different experience base, a different point of view. And so I think there's two things, this and one other, that the ability to not just tolerate a different point of view, but look for a different point of view and really actively understand why that person thinks differently than you. Because I can guarantee you, your tenants think differently and your customers think differently. So that's how you anticipate the next great trend, I think, is through curiosity and inclusion, diversity. The last thing I would say is a willingness to do the things that are really good for the firm and good for your colleagues, but not necessarily the most fun. Now, if they're not the most fun, they're not going to give you a ton of energy, and you're not going to want to do that all week long. But I think every organization appreciates somebody who says, that's important, and I can't do it by myself, but I'm willing to step up and pull a team together to get that done. You know, a new initiative, a new project, some research in a new asset class, whatever it is. I think not being the martyr, but just being willing to do what's right for the firm. You know, it really stands out, and I think that people begin to think of you as a leader, not just a strong individual contributor, but a leader.
Yeah, that was great. Thanks for the insight.
You're gonna love this one. A very friendly man's about to hop in here. He's already smiling. He knows who I'm talking about. Pranay.
Hi, Mr. Whitelaw. It's been
Hi,
great
Pranay.
hearing from you today. So one question that I did have was about the real estate market in terms of residential properties, because like I read a new report that said within 17 hours of a new listing, at least in Massachusetts, there's already one bid that comes in. And I just wanted to know, what do you think are the reasons behind the recent real estate boom, especially in the Northeast of the US, and how sustainable do you think it is?
Yeah, my 30-year-old kids ask me the same question every day. And you're talking here about single family residential primarily?
Like, yeah, any mix of residential mainly.
Yeah. Well, I think, again, COVID's an accelerant. You know, if you're living in a 500 square foot, my daughter and son-in-law lived in New York for 10 years. She went to Columbia and they had a very small apartment, but they didn't spend a lot of time in the apartment. You know, they ate out. They went to movies with friends. You know, they had brunch all the time. They didn't have much of a kitchen and they had virtually no dining room, but they lived out. In COVID, we can't do that, right? So it's clearly accelerated a trend to more space. I do believe that was kind of inevitable. And hard as it is, we've been trying to build a little bit bigger apartments where you could at least have a closet and a kitchen that has more than a hot plate, you know, that sort of thing. So I think that's good, Renee. I think that's a trend that was going to emerge anyway. I do think the pricing is scary. But you know, you look at a city, not just New York or London, but you look at Milan or Amsterdam. There aren't a lot of single family houses, you know, until you get way out. And I think what's happening is North America is evolving from an automobile oriented environment where most people lived in the suburbs to one that is more like Europe. And you know, that takes a few generations. It's hard to assemble a block, but I think that's going to happen over time. So there's a certain amount of just natural economics to the price run up. But I do believe it's gotten and gone beyond already the point of reasonable affordability for most. And that's what will drive the zoning changes and the other changes that are necessary to go from primarily single family to probably primarily, you know, if you're a wealthy person in London or Paris, you don't expect to have a single family house. You expect to have a nice flat. Yeah. And I think that's the way it'll be in 2 or 3 generations. Just be careful that you don't get to a point where you've got a mortgage that relies on everything going perfectly. You know, I've been there in the 90s when residential real estate corrected by 1/3, and I didn't know for sure. And the company I worked for was wiped out, and I didn't know how I was going to make my mortgage payment. And you know, that's not a great place to be. So just, I sound like your grandfather. I'm sorry, but just make sure that you know you've got a margin of safety.
Yeah, that makes sense, definitely. Thank you so much.
Yeah, definitely live within your means, right?
Yeah.
Definitely. But let's see who else wants. Yeah, Ryu, go for it.
Oh, hi. Thank you so much for coming in today, Mr. Whitelaw. I guess this would be a question that would kind of sort of like follow up on like kind of Elijah's question earlier, where you previously mentioned basically kind of green flags of hiring certain people or dealing with certain clients. I guess from your experience, I would like to know like what were certain red flags that you wish you never like kind of you wish you avoided, and like red flags that you hope to kind of like avoid, if that makes sense.
Yeah, it makes a lot of sense. And I'm sorry, now that you mention it, Elijah, I don't think I ever got to the second part of your question. So I'll try to come back to that. Well, I think if you're working with good people whom you respect and who treat you with respect and have the right ethics, you can make a lot of mistakes and still enjoy what you're doing. The flip side of that is that if you're with people whose values don't accord with your own, don't view you as a really important part of their success, then I think it's hard to enjoy the rest of the job. I did find myself at one point working for a firm who was very good and very successful, but it really, in my view, it really didn't treat the people that invested in them and with them with the respect they deserved. I think they kind of viewed it as a commodity, and shame on you if you don't look after your own best interests. And my dad caught me referring to them in the third person all the time. And he didn't have a college education. He worked in a factory most of his life. And he just turned to me and said, "Gee, you take a paycheck from them every 2 weeks, and yet you don't say we, you say they. Is that really how you want to spend the next 10 years?" So I think focusing on what their values are, what their track record is, ask if you're interviewing with a firm, you're interviewing them as much as they're interviewing you. And I think ask some good questions. And if they don't want you to ask good questions, my guess is they're not that interested in you and what you think. They view you as a widget. And I think get a sense from Glassdoor and from colleagues perhaps, or whatever, what people feel that the culture is like and the work environment is like. And that's, I feel lucky that I haven't made that mistake too many times, but I made it twice, where I got in there and I realized that I didn't ask enough questions. And 6 or 9 months in, I thought, geez, this is not where I want to be for very long. And that's that's life. You're not going to get it right every time, but I think it can be mitigated by that. Does that address the question, Ryu?
Oh, yes. Thank you very much.
Elijah, I think you were asking at the end of your question how you keep good people and what to look for in culture. Is that fair synopsis?
Yeah, exactly.
I think you have to help people invest in their careers, and you have to give them a voice. I think having upward evaluations, 360s, where my daughter's working in a place right now and she's just changed groups and she's in a wonderful division now. The group she was in before had absolutely no upward evaluation of leadership, which in this day and age, I think is amazing. The group she's with now is really good that way, that, she knows that they really care what she thinks. Now, they have performance expectations, of course, but it's a two-way street. And she will walk through fire for the leadership of this group. Whereas, she did a very, very good job, but she didn't feel any loyalty or allegiance to the other group. So I think, that's another question you can dare to ask. How do you evaluate your employees? How do we evaluate leadership? And see what the answer is. It'll tell you a lot about the culture.
Yeah, thank you. That's a great insight. Thank you.
Running off that, Gary, what's your opinion on radical transparency within a workplace?
It's important. When we came together as BentallGreenOak, building one culture, not having two cultures that sort of passed in the night or like a Venn diagram occasionally overlapped, but trying to build one culture was really important. And Sonny took that on as one of his most important projects coming out of the initial merger. And so we pulled a culture crew together and had someone that had facilitated this process, keep it top of mind and keep us moving. And we tried to develop, a list of the 4 or 5 things that we thought were really important, and then subcomponents like the kind of behavior that you would see within each of those buckets. And radical candor was one of them. I might call it respectfully radical candor. I think there's ways of communicating that you have a different point of view without intentionally pushing buttons or being disrespectful. I think the minute you're disrespectful, people turn off. And that goes both ways, right?
Yeah.
So but there's, the more senior you are in a company, the less you know about what's really happening. And if people feel like they can't be really candid and honest and frank with you, it's very scary because you have no clue what's going on. The iceberg of ignorance. And so I think it's having an environment where people feel like they can disagree, have reasons, not just to be a shit disturber, but I hear you, that's legitimate, but I see it a little different. I think that's so important, and the only thing that I struggle with a little bit, Michael, is the radical, because that to me can mean exaggerated or a caricature. But I don't think it should be just incremental. We're trying to do a reorganization in one part of the business right now, and my concern is that people are attacking it too modestly. I think it needs to be radically changed, but transformed, not blown up.
Well said. I appreciate that. Cole, I see you have your hand up again.
Yeah, I had one question. You mentioned micro markets a bit, and for life sciences, I was interested. The first market for me that comes to mind is Cambridge, but are there any others for life sciences or data science?
Yeah, Del Mar and La Jolla, San Diego, that area is fantastic. I would focus, Cole, on the universities. So often they're in Toronto here, for example, there's the Mars district, which is the medical research district, and a whole bunch. It's an incubator for a whole bunch of spin-offs in life sciences. So look for the great universities and university towns such as Cambridge and Boston, and you'll find those micro markets. Not all of them, but that's a good starting point.
Thank you.
So, Gary, 10 minutes passed. You're tired. You gave us all of your time. I'm sure you probably want to hop off now, and I definitely will respect it. But I think one thing worth doing before hopping off, for the sake of the video, I think there's one question we should include, and it's good for everyone to hear anyway, which would be, how profound do you think the impacts of COVID will be on various formats within commercial real estate? And will these forces be irreversible? That question, do you think, I think that's a good one to include in this. So I
Yeah.
think maybe we could finish it. I'll ask maybe just that one more. We can include that in the video too. And then I'm sure you're ready to hop off.
Well, I've enjoyed this very much. I don't know. I don't have a crystal ball. I think there's unquestionably aspects of this that are irreversible, you know, as the steam engine was, and, you know, so many different, I'm trying to remember the saying. Sometimes it takes years for progress. Sometimes it takes, you know, minutes or days. I think this is one of those greatly condensed periods. You think about the technology that's come out of crises, you know, be it wars or other things in the past. So much technology has come out of times of global conflict. I think telehealth, for example, is never going backwards. There's e-commerce is never going backwards. Will people want to get on subway trains and avoid lengthy, frustrating commutes in cars? Absolutely. You know, will people want to travel and stay in hotels? I think business travel may not be as strong. You know, I spent at least every other week on the road 4 of those 5 days. That really cut into other things that I could do. And instead of going to see CalPERS in Sacramento 4 or 6 times a year, in the post-COVID world, I might go 3, but not 0. Like, you know, those in-person lunches and time spent together, truly understanding each other, really, you know, really having the kind of conversation that's hard to do. Once you know somebody, you can do it over Zoom, but it's very hard to get to know somebody, and it's very hard to understand the body language and how people really feel and build that trust. So I think we're going to see a return to many of those things, but perhaps not to the same extent. And I think we were oversupplied retail. The US had almost twice the retail per capita that most developed countries have. That was bound for a correction, right? So that's not going to come back. But the kind of retail that gets people off their couch will probably thrive more than ever because there's pent-up demand for it, and people are going to be dying to have that. You know, I think it will take some adjustment. We've been in a tunnel for a long time, and you know, the way your eyes blink when you get out in the daylight, I think it's going to feel a bit weird to have to get up at 6 o'clock to commute to the office and do all those things. But thankfully, I don't think we're going to have to do it 5 days a week, every week. I think there'll be more flexibility around that. So I think COVID is a very serious, I'm repeating myself, accelerant. But I think the need for people to come together and really collaborate and share ideas is never going away. So, you know, to me, that's the driver. Just think through, what are the activities that benefit from that? And if you're, you know, I mentioned power centers before. We felt for a very long time that consumer electronics and pet food and, you know, things like that, why do you need to park in a parking lot and get a shopping cart and, you know, do that? That's over. But I still think it's fun to go to a movie with a whole bunch of people. And it's really fun to go to a concert and a sporting event and to get on a plane and visit a city you don't know and explore that city, you know? So I think it's things got overvalued, and I think we've seen some value adjustments. And quite frankly, we might be seeing a run up right now in industrial with cap rates where they are. That's priced to perfection. But that means something else is undervalued, and it will. So there's always 2 factors in the equation. Where's the demand and what's the pricing? and balancing those two factors is the art.
Thank you, Gary. Well said. And it's been an absolute pleasure having you here with us tonight. I couldn't thank you enough, but just thanks again, truly. Thank you.
It's my pleasure. It's so nice to see you all. And I really want to thank you for your questions and your engagement. It makes it fun. And I was delighted, Michael, when you reached out, and I'm so pleased that I had this opportunity. Thank you very much.